Welcome back. You're watching Your World at 10. We have with us Paul Sheard, the Chief Global Economist of S&P Ratings, to talk us through not just the ECB action, but also his view of the global economy in 2015, which is the prevailing conversation here in Davos. But first up, 60 billion euros of private and public bond purchases. That was the announcement coming in from the ECB. What do you make of the size, the fact that it seems to run through the course of 2016 and it's open-ended, and what that will mean in terms of the effectiveness of such a QE?
Well, I think it's a good decision, Menaka. I mean, one can always hope for more, but I think it's a fairly decisive issue. A couple of key points are that the ECB has crossed the Rubicon now of doing what I would call plain vanilla quantitative easing, or what for other central banks would be plain vanilla. That is, buying government bonds to expand the balance sheet and inject liquidity into the banking system. Now, the ECB has been very reluctant to take this measure, but now that debate has been had. And this is important because central banks typically, they may take a long time to come to a decision. They're conservative institutions, and the ECB obviously had some challenges with this decision. But once the decision is made, typically there's no turning back. So this has really pushed the ECB, or launched the ECB into a new monetary policy regime. Now, it will not be a silver bullet by any means, but it does mean that the ECB now is going to be really focused on doing its job, which is trying to get inflation back close to 2%.
Now, what do they mean by purchasing both private and public bonds? If you could just walk us through what they'll be buying, and especially in the public bonds. Are they going to be buying sovereign debt from central banks in other Eurozone countries? Is that how it works?
Correct. They'll be buying basically government debt securities from 2-year to 30-year maturity. Now, this decision comes on top of, or it incorporates decisions that were made in December of last year, where the ECB announced that it was going to purposefully expand its balance sheet back to a level of around about 3 trillion euros by buying covered bonds, asset-backed securities, and also using targeted long-term refinancing
LTRO,
operations. Now, the problem with those measures, particularly covered bonds and asset-backed securities, is it's difficult to get very much scale. So what the 60 billion euros per month includes the asset-backed securities, covered bonds, but now the new one is sovereign bonds, and that will be, I think, the bulk of the asset purchases here. Now, there are some interesting tweaks in the decision, and bear in mind Mr. Draghi's press conference is still going on as we speak. But there is a interesting twist, which is an element of so-called loss sharing, potential loss sharing. What would happen if some of those bonds that the ECB bought actually ended up defaulting in the future? And basically there's going to be a sharing arrangement where the national central banks will take about 80% of the losses. The ECB will take about 20% of the losses. But an important point here is that the ECB has also said that it doesn't have to do it this way. This is a choice it's made. The Governing Council is unanimous in saying that this is a monetary policy issue. It's not a monetary financing issue. So there's a unanimous decision by the Governing Council that this is okay to do. Not everybody agrees they should do it, but it's okay to do. And if the ECB could, if it wanted to, bear all the potential losses itself, but it's decided to distribute them with the national central banks.
The sovereign bond purchases, how will they decide how much to buy from each country? Have they worked that out already?
Well, again, that has been announced, Menaka, that they will follow the so-called capital key. That is in the equity shares, if you like. It's not really equity, but the shares that each national central bank has in the ECB, which those shares also reflect essentially the size of the economy. So it will be across the board essentially proportional to the size of the economy, which means it won't be, for example, proportional to the size of the bond market, or it won't be aimed at specific economies where there is more distress and perhaps more need for monetary easing.
But that's absurd, right? Because the German economy would be the largest economy in the Eurozone, and they don't really need to buy German bonds.
They don't, I mean, Bund yields are very, very low. But again, the ECB as a central bank for the whole Eurozone, which is now 19 countries, has to set monetary policy for the whole Eurozone, not for individual countries. It would be like setting monetary policy for individual provinces in India. And this is one very sort of standard way to do it, to really buy across the whole bond market. It doesn't mean that just because bond yields are low in Germany now, pushing them a little bit lower won't have any effect. There could still be some effect, particularly from the expectations channel. I think this is one of the things that often people miss. One of the most important channels of this quantitative easing, again, it's not a silver bullet, but one important channel is just the sort of confidence that it gives the markets and the public that this central bank has got the tools and is using those tools. The finer details of how the transmission mechanism works, we can argue about till the cows come home, but I think the fact that the ECB is stepping up in a relatively aggressive fashion is something to be applauded at this stage.
Okay, I know Davos has been discussing or debating the necessary, not sufficient aspect of QE, but is this going to be effective in your assessment? Will this help the Eurozone get anywhere close to its targeted 2% inflation rate?
I think over time it will be, will be quite effective, and markets always discount everything,
sure,
including policy moves. And of course, the euro has already weakened substantially in the last few months in anticipation. And again, the signalling effect of QE seems to work to a large extent. But one important channel is through the exchange rate, and the eurozone would benefit from a weaker exchange rate. After all, GDP is still below the pre-crisis peak. Unemployment is 11.5%, well above the pre-crisis level, and headline inflation has actually dipped into negative territory.
Right.
So there's a compelling case for the ECB to try something, and it's not pioneering quantitative easing. We've seen the Bank of Japan, the Fed, the Bank of England, all of these central banks adopt this kind of quantitative easing, and it does eventually have some beneficial effect. It doesn't solve all the problems in the economy, though.
Are we looking at a euro that is at parity with the dollar by the end of this year?
I mean, we're not really foreign exchange forecasters
I'm not asking
in that
for
regard,
forecast, but I think the general trend is towards that, according to you?
Most economic theory and economists would tell you that if you have this, monetary policy is a key determinant of exchange rates. And what we have in the global economy now is really what I called last year in my report a parting of the ways. Monetary policy, particularly at the Fed and the Bank of England, going in one direction, and the Bank of Japan, under Mr. Kuroda, of course, is very aggressive, open-ended quantitative easing, creation of the monetary base. Now the ECB has sort of jumped on the QE bandwagon, and it is open-ended, even though the announcement is for a certain expansion by September 2016. It's also added that it will continue this policy until it achieves its objectives. So that's a very important point. So we have these two central banks, Bank of Japan and the ECB, really in full flight QE mode now. The Fed likely to be beginning to hike interest rates, we think, could be by mid-year, certainly this year. Bank of England probably joining in as well. So that would argue for upward pressure on the dollar and downward pressure on the yen and the euro. And it's probably got further to go. Okay.
This divergence in monetary policy action comes after a few years of central banks working in tandem, so to speak. What kind of impact will it have, for instance, on currency you've already touched upon, but on global fund flows? I know India is concerned about what that will mean for us, from a currency point of view, from a fund flow point of view. What is your assessment?
Well, it will have some impacts, but really the impacts will be driven by what the millions of investors around the world decide to do with their portfolios. The liquidity that these central banks create with quantitative easing itself doesn't directly flow into currency markets or through national boundaries. It really sits in the portfolios of the people who sell the assets to the central bank. So the key, Menaka, will be how do market participants and investors react? And there's not necessarily just one simple way. That could be, there's a market out there, so there'll be a diversity of opinion. But generally one would expect that flows into the US would be a little bit stronger now. Growth is returning. Interest rates are starting to move up. Not many central banks in the world where you can say that, so that will be, again, a bit of a gravity attractor for the dollar. But I think emerging markets, we had the taper tantrum 2013. Obviously, there will be implications for emerging markets, but I think emerging markets will really have to focus on their own domestic fundamentals. And the emerging markets that are really focused on structural reforms at home, good macroeconomic policies, they will be able to accommodate these fluctuations that occur because of investment flows.
All right, fair enough. That brings me to my last question, which is mostly on India. We're in a much better macroeconomic position now than we were when the taper tantrums took place. In fact, we have, I think, Nomura and some other firms forecasting a current account surplus in the second half of the year, so to speak. The fiscal deficit target the finance minister promises us will be met. How do you assess India? And given the global context that you've just spoken of, do you think it will be a challenging year for India in terms of currency, fund flows, or do you think it will be a year of return to growth?
Well, I think India has been growing. Certainly in the last couple of years, growth started to decelerate.
Yes.
We think it's probably now turned the corner again and is picking up. So India should be able to grow at 5-6% or so, which for an economy of its size is quite a decent growth rate in this very challenging global economic environment. India is always, as a very large emerging market economy, sort of in the shadow of China. And certainly its growth performance has not been as strong as China. But I think there's considerable scope to be cautiously optimistic about growth to pick up over the next few years, particularly if this newfound energy and reform momentum in India can be maintained and really executed well. There's a tremendous growth potential in India. India has many pluses, I think, going for it, but it's a matter of putting it all together, staying focused on the right policies and seeing them through.
Let's hope we get it right this time. Paul, thank you so much for your time and
Pleasure.
enjoy the rest of your stay
Thanks
here in
very much.
Davos. Thank you.
Thank you.